In this video, we will discuss the principles of insurance. Let's begin with the definition and benefits of insurance. Insurance is defined as a means of managing financial risk by transferring the risk from one party to another through a legal contract or other arrangement. This means one person, known as applicant, policy owners, or insured, transfers potential financial loss to an insurer who assumes the risk in exchange for premium payments. The law of large numbers helps insurers more accurately predict losses. As the number of insurers increases, it helps mitigate the effects of adverse selection. Adverse selection occurs when an insurer is unaware of a higher risk level due to misleading or inaccurate information provided. Insurance benefits society by offering loss control, loss payments, and securing credit. Indemnity refers to protection from financial loss, and most insurance contracts operate on this principle by compensating insureds for covered losses to restore them to their financial position prior to the loss. Section 2. Pure risk versus speculative risks. In insurance, risk refers to the uncertainty of a potential loss, which individuals can transfer to an insurer through a policy, while risks can take many forms: theft, damage, personal injury, and injury to others. Only pure risks, those involving the possibility of loss without gain, are typically insurable. A speculative risk is any kind of risk that could result in either loss or gain. Because the purpose of insurance is to return an insured to their financial status before a loss occurs, a risk that could result in a profit or other form of gain is not insurable. Only pure risks are insurable. It is impossible to insure every type of risk. Don't miss this though, it's bound to be on the test. For a pure risk to be insurable, it must involve a chance of accidental or unintentional, measurable, and definable loss. Let's look more into what makes a loss insurable. For a loss to be insurable, it must meet several criteria. It must be accidental and outside the insured's control. Example, an insured catches a cold. It must be definite and measurable, with time, place, and amount documented. Example, a car accident at 2 p.m. on Friday causing $2,000 in damage. Predictable, so insurers can estimate future losses. Example, 18% of accidents involve distracted driving. Non-catastrophic, meaning not excessively large or uncertain. Example, war, nuclear disaster, or a $1 trillion life policy are uninsurable, and based on a large, randomly selected group of exposures to apply the law of large numbers effectively. Section 3. Property loss exposure and liability loss exposure. Loss exposure is simply defined as the possibility of financial loss due to risk. The severity of an individual or entity's loss exposure increases or decreases depending on their habits, location, and many other characteristics. Example, someone who drives 30 miles to work has a higher auto loss exposure than someone who works from home because of their increased chance of an accident. Here we will distinguish between two types of loss exposure: property and liability loss exposures. Property loss exposure, the risk of losing a property's value or use due to damage, loss, or inability to serve its intended purpose. Examples are physical damage, destruction, loss of functionality, and loss of use. Property loss example, a damaged taxicab loses money and repair costs while out of service. Liability loss exposure, loss arising when the insured's negligence causes injury or damage to another party, requiring payment to compensate that party. Example, Hilda is distracted while driving. She hits another driver, whose car is totaled, and the driver stays in the hospital 2 days while recovering, missing work. The damage to the other vehicle and the other driver's medical costs are examples of liability losses, and the chance of those losses occurring are liability loss exposures from the act of driving a vehicle. Section 4. Loss. Let's talk about how insurance defines loss. In the insurance industry, loss is defined as any injury or damage suffered by the insured because of an accident or event covered under an insurance policy. Covered losses are what form the basis for insurance claims. Both property and liability loss exposures may lead to loss, depending on whether the insured suffers the damages or injury themselves, or if the insured inflicts damages or injury to another party. Exam tip: make sure you distinguish loss exposure from loss. Loss exposure is the possibility that loss may occur while loss, is the damages or injuries that are actually incurred. Remember the car accident? The loss exposure is the driver using her vehicle. The loss is the car damages in the accident and the hospital stay. Section 5. Perils and hazards. A peril is an event, situation, or circumstance that results in property damage or loss. Insurance policies define what perils are covered and which are not in the insurance contract. Common perils included fire, theft, windstorm, and vehicle accidents. Common perils excluded in basic plans and need a stand-alone plan: earthquakes, floods, sinkholes, certain types of water damage, wear and tear, and intentional damage, losses for renters. A hazard is a condition, circumstance, or situation that increases the chance of a loss occurring or increases the severity of a loss. Hazards fall under one of 4 basic categories: physical, moral, morale, and legal. Section 6. Risk management. For your state exam, it is important that you are familiar with the 5 primary methods of handling risk: risk retention, risk sharing, risk avoidance, risk reduction, and risk transfer, also known as insurance. Risk retention is when the person, business owner, or professional decides to retain part or all of an exposure to a given risk. This means that they will be fully responsible for any losses that occur regarding the retained risk and will need to pay any necessary repair, replacement, or compensation required out of pocket without the help of an insurance company. Risk sharing, or risk distribution, occurs when a group pools funds to cover potential losses any member may face, spreading the cost among all participants. This is a form of self-insurance without an insurance company involved. Example: Amish groups share the cost of expenses that come up amongst themselves. Risk avoidance is when the person, business owner, or professional consciously seeks to avoid or eliminate loss exposure to a specific type of risk. The idea is that if you never expose yourself to a certain risk, you never have to worry about suffering a related loss. Example: avoid skydiving or bear fighting, and you avoid risk of getting hurt. Risk reduction is when the person, business owner, or professional is making a conscious effort to minimize the frequency or the severity of losses. Instead of avoiding a risk entirely, the strategy of risk reduction accepts that loss could occur and instead takes steps to mitigate how often a risk may occur or how expensive a loss from such a risk would be. Example: a business owner installs a sprinkler system in the warehouse to prevent fires from spreading/loss reduction. Risk transfer is the strategy of shifting the risk of potential losses to another party, typically through a formal contract and in exchange for some form of compensation. Sound familiar? Insurance is the most common risk transfer method used today. That concludes this section. You did it. I hope you have learned more about the principles of insurance. Check out the next video to learn more.